Some of the smartest people in America lose money in the stock market. Doctors, engineers, attorneys, tech executives. High IQ, high income, still broke, still stressed, still making emotional decisions with money. Why? Because investing isn't a math problem. It's a psychology problem. And unless you understand how your brain works under pressure, you will eventually sabotage your own wealth. Today we're breaking down the hidden psychological traps that destroy portfolios and the calm investor framework that prevents it. Most people think being smart protects you financially. It doesn't. In fact, intelligence can make investing harder. Why? Because smart people overestimate their ability to predict outcomes. They believe they can outthink the market. They consume more information. They build more complex strategies. They trade more frequently. And ironically, they often underperform. The data consistently shows that the more people trade, the worse their returns. Because every trade is influenced by emotion. And emotion is expensive. Let's break down the biggest behavioral traps hurting American investors. First up, recency bias. Recency bias is the tendency to believe that what just happened will continue happening. When the market is booming, people assume it will keep booming. When it crashes, they assume it will never recover. Think about 2021. Meme stocks, crypto explosions, retail investors flooding apps. People weren't investing. They were chasing momentum. Then 2022 happened, and panic selling replaced euphoria. Buy high, sell low. The exact opposite of wealth building. Next is herd mentality. Humans are tribal. If everyone is buying tech stocks, you feel pressure to buy tech stocks. If everyone is talking about real estate, you feel behind. This is how bubbles form. It's not greed alone. It's fear of being left out. The housing bubble of 2008 was fueled by the belief that home prices always go up. When everyone agrees, it feels low risk. But historically, that's when risk is highest. Now let's talk about overconfidence bias. Ask the average American investor if they think they're above average. Most will say yes. Overconfidence leads to ego-driven mistakes that markets quietly punish. Finally, loss aversion. Psychologically, losses hurt about twice as much as gains feel good. Losing $10,000 feels worse than gaining it feels good. So what do investors do? They hold on to losing stocks hoping to get back to even. They manage emotions instead of managing strategy. And long-term, that destroys compounding. Even retirement accounts aren't immune. Many Americans contribute to 401ks, but when markets drop 20%, fear kicks in. They move to cash to wait until things calm down. But by then, the recovery has already happened. Missing just the best 10 days in the market over 20 years can cut returns dramatically. Calm is not when wealth is built. Discomfort is. So how do you fix this? You build systems that protect you from emotion. Step 1. Automate. Automatic contributions. Automatic investments. Remove decision points. Step 2. Diversify intelligently. Broad market exposure. Low-cost index funds. Not what's trending, but what's statistically resilient. Step 3. Pre-commit to volatility. Before the next crash, decide how you will respond. Write it down. When the market drops, I will continue investing. Because in the moment, your brain will try to protect you. But volatility is not danger. It's the price of admission for long-term returns. Building wealth in America is not complicated. It's boring. Consistent investing, long-time horizons, low fees, emotional discipline. The market rewards patience more than brilliance. The greatest investors are not the most intelligent. They are the most emotionally stable. If you want to win financially, stop trying to outsmart the market. Out-discipline it. The biggest threat to your portfolio isn't inflation or the Fed. It's the person in the mirror. Master your psychology, and wealth becomes inevitable.